Hi everyone, Fritz here. In this video, we're going to go over the money pitfalls to avoid in your 20s. Starting off early into adulthood, you're probably going to be bombarded with a lot of offers for credit card deals like 0% interest rate, as well as extra bonus points if you sign up with this credit card versus that credit card. And one of the things that you have to look at when considering those offers is that will you be done paying off the credit card by the time that the promotion is over, because those promotions do end. And you could be seeing upwards of 25% interest rates and higher depending on when you're watching this video. All these companies are incentivizing you to spend more money, but no one is incentivizing you to save more money. What happens if there's a rainy day fund that you need that you don't have because you spent it all? You're not building strong saving habits for the future if you keep on spending. So don't be fooled into spending when you could be saving. But don't get me wrong, credit cards can be great, especially if you can use the points into your favor and if you're not paying the additional interest rates as well. For example, I bought this suit and this shirt for only 98 cents because of all the points I accumulated with the credit card that I had. And I was only using that credit card for things that I would already be spending on, like gas. Another type of loan, this one trips a lot of people up, is student loans. With student loans, you want to make sure that you're using the student loans in order to pay for things related to school. Your tuition, your books, anything like that. But you don't want to be spending your student loans on your rent, your car, your normal day-to-day living expenses. That's not what your student loan was meant for. And if you do spend it on those things, you'll be having a much harder time paying it off in the future. And you may even be taking out a bigger loan than you need to right now. Another thing that you want to consider with student loans is, do you need to go to school? And this is a very serious topic nowadays, especially with the internet around. And that's because schools were highly coveted because of the information that they provided. The information was rare, it was hard for people to obtain it, so you had to go to school to get this information. Before it used to be so easily, you go to school, you get a 4-year degree, and you have a great paying job. Now, not so much the case, because there are a lot of jobs that realize the power of the internet, and a lot of jobs are being created that do not require college degrees and still pay very, very well. Now, if you need your degree for something like becoming a lawyer, becoming a doctor, then by all means, go to school, go to graduate school, get the degree that you need in order to become the profession that you desire. But if that is not the case, you have to look at the financial hardship that is going to be ahead of you. Will your profession with a college degree, if it's needed, will it pay off your student loan debt in a timely manner? Will it prevent you from buying a house later on? Will it prevent you from starting a family when you want to? These are all things that you have to take in consideration when taking out a student loan debt. However, if you decide that school is the route that you want to go in, it ties very nicely into tip number 2, and that is when you're looking for a job, look beyond the hourly dollar amount. What I mean by that is there are a lot of opportunities within schools, say for example work-study programs, that will pay you an hourly rate, yes, but they may also offer you a lower amount of tuition as well because you're working for the school, you're helping promote the school. So you may get your regular hourly rate, might not be the best, but the amount that you get back off of your student loan or your tuition is going to be vastly outpaid versus anything else. So take that into consideration as well. Another thing that you're going to want to look into is benefits. Now, some of you may have the luxury of being on your parents' benefits plan, but for those of you who need healthcare benefits on your own, you're going to want to look into a job that might provide you for the benefits that you need. If they offer you some partial benefits and you have to pay for a little bit of it, or complete benefits and you don't have to pay for anything at all, that's going to be something that you want to take in consideration when you're looking at the cost of everything. Another benefit that gets overlooked is, does the company offer you a 401k? Specifically, a 401k where the company will match you, because relatively speaking, that's free money. For example, the company will match you up to 4%, so if you provide 4% in your paycheck, the company will match that. For the most part, I would recommend going up to the matching value because that's free money that you're just getting from the company. And you're gonna be grateful that you have it in the future as well. Now, some companies, if you're lucky, really lucky, they offer a base amount to go into your 401k without you having to put in any money. That's a great benefit. If you can get something like that where you don't have to contribute into your 401k in order for it to grow, that's something definitely that you should consider when looking at your job. So again, a job is worth more to you than just the dollars per hour. Going back to loans, This one, a lot of people do this mistake. I had a lot of friends who made this mistake, and that is buying an expensive car. A car that is beyond their means. You don't need to buy an expensive car, because if you buy an expensive car and if you're unable to pay it off, you're gonna lose it. You're gonna lose all the money that you put into it, and it's gonna be gone in just a little bit of time. Another thing to take in consideration with expensive cars is that cars depreciate very, very fast. My car, I think I bought it for about $20,000, maybe about 3 or 4 years ago, and now it is worth about $5,000. For the most part, they are a liability, not an asset. Of course it's an asset because it can take you from where you are to where you need to be. Other than that, if we're looking at just the money aspect of it, it depreciates very fast and is a liability. However, I do understand that most people need a form of transportation. The amount that you're gonna spend on your car should be no more than 10 to 20% of your income, and that includes the insurance as well as the gas. Number 4 might be a soft spot for a lot of people, but owning pets. If you had a pet growing up, then of course you're gonna wanna keep your pet. I'm not telling anybody to get rid of their pets. I'm just saying is if you're willing to take on a pet in your early 20s, just understand the financial restraints behind it as well. If you're able to do it, perfectly fine. But there are some great options out there as well that I just wanna throw out. If you really want a pet, consider adopting a pet, especially those that are orphaned. You don't have to spend a lot of money on your pets right away, because on average you're going to be spending about $100 to $150 on them every single month. We have to take care of the food, the toiletries, maybe they have some medical expenses as well, but let's not forget, now that we're talking about medical expenses here for your pets, they may have some unforeseen expenses later on down the road. That's why you want to be able to save in the beginning, that way you're able to pay for things later on. And having pet insurance might also be a thing that you want to consider from your employer as well. Number 5 is a mistake that I almost made unless I had a friend refer it to me as well. Placing all your money into one place. For me, I only had my money in a bank account. Bank accounts, if you didn't know, they do not grow your money all that well. Some people think stocks are great. Unless you're a very savvy investor, stocks are very hard to manage. And it's hard to know about which stocks to invest in. And as a rule of thumb, if you start to hear about a stock, it's too late. The time that a stock becomes popular, it's too late to invest in it. It's more or less reached its peak growth, just as a rule of thumb. Now, if you're getting free stocks from your work, then by all means, go ahead and invest into it because you're getting it for free. Or when I say truly diversifying yourself, I mean not having different bank accounts or stocks or mutual funds, because a lot of those things fall into the same category. If you want a truly diverse portfolio, you're gonna wanna maximize the tax structure. And that's having things in the tax now, tax later, and tax advantage section as well. And if you're not sure what I'm referring to, I'm gonna include a card up here to another one of the videos that I made not too long ago. This will help you get all the tax saving benefits from having money easily accessible now, money accessible in the future, and money accessible in the middle to long term as well. This is what helps you have a fully, truly diverse portfolio and will allow you to be ready for anything that life hits you with. So again, the 5 pitfalls are gonna be living off credit cards and loans, not looking beyond your hourly wage, buying an expensive car, not properly expensing, having pets, and not having a diverse portfolio. If you have any questions for me, leave it in the comment section below. If you enjoyed the video, give it a like and subscribe so you don't miss out on awesome videos like this in the future. I hope everyone has a great day, and I'll see you in the next video.